You make really big money by buying stuff that's out of favor way too early. And when it comes into favor and you're enjoying these rapid price escalations, you come to understand with some experience that when the narrative itself becomes popular due to price, that the narrative is less valuable. When the price of uranium was 8 or 10 US dollars a pound, I believe it had to go to 30 and it could go to 40. And it went to 130. Really, from my point of view, everything above $50 was gravy. But every $10 increment in terms of price that the market enjoyed made the market itself more popular, which is to say nobody wanted to buy the stuff when the price had to go up, and everybody wanted to buy the stuff when the price had to go down. At the beginning of the exercise, what happens is very pernicious, which is to say, particularly if you believed in the narrative before other people did and you had your faith tested. When the narrative comes true and you're starting to make money and feel smart, the price action that you see in your own mind justifies the narrative. And you come to believe more in it, even as it's less valuable. When the price of uranium went from 10 to 40, the fact part of the narrative was already done. It doesn't mean that the price of uranium couldn't go higher. In fact, it did to 130. But people forget that markets work. There's a lag. But when the market went to 130, there was no reason for it to go up and every reason in the world for it to go down, which of course it did, falling from 130 to about $80 before the Fukushima event took out the demand side for uranium. So for me, I began to be a fairly aggressive seller when the price of uranium no longer needed to go higher. And I would do it again. What I tell people in terms of the sell decision is, first of all, review why you bought a stock. And review when you buy the stock, what you think the probability of the favorable outcomes would be, and why, in a very broad sense, what price you think something can go to. If I look at a gold stock, I think the probability is in 2023 that gold goes through $2,000, maybe to 2,100. And so when I'm running a pricing metric on a gold stock, I'll run a downside case, which is to say $1,500 gold. I'll run a present case, $1,900 gold, and then I'll run a $2,200 valuation. If the gold price does go to $2,200, and I have a sense what the net present value of the free cash flows of the company at $2,200 would be, if the price of that stock escalates substantially beyond what I believe to be fair market value, I begin to be a seller, regardless of the technicals, regardless of momentum, regardless of any of that. For me, when the reason to own a stock begins to go away, the stock needs to begin to go away. And that's in a successful case. In an unsuccessful case, it's much easier. If you believe that XYZ has to happen in the uranium market, and the uranium market, for whatever reason, doesn't perform. Perhaps the pace of Japanese restarts isn't sufficient to accommodate supply overhang from Canadian and Kazakhstani restarts. And perhaps what happens is that you don't need the incentive price in uranium because there's enough uranium in the market to accommodate demand. I don't believe that to be the case. But if that gets proven to be the case in 2024, I will need to reset my valuation targets. At the beginning of the last bull market, there were 5 uranium juniors, and all of them had good assets and good management teams. So you didn't have to be picky at all because the universe was non-existent. We now believe there's between 75 and 80 public companies worldwide in the uranium space. And we believe that somewhere between 11 and 15 are buyable. So, yeah, I would suggest that you have to be much more picky. Now, there are people who are intelligent speculators in the uranium space who are willing to ignore probabilities in favor of 10 or 15 to 1 returns. which is to say they're willing to take very, very long odds, longer than I feel I need to take, because they're willing to lose almost all of their initial investments in hopes of generating a 10 to 15 bagger. In those circumstances, what they're going to need to do in almost every case is see a truly spectacular run-up in the uranium price or enjoy exploration success, which is to say they're involved in a $10 or $15 million market cap company that isn't a uranium company per se, but rather a company that's exploring for uranium in fertile terrain. If you're willing to play that game, and that game's been very good to me over the last 50 years, if you're willing to play that game, you need to understand that uranium's only part of the narrative, that what you're doing is buying an exploration stock. And you need to follow their exploration progress very, very, very carefully. The normal outcome, particularly in sole risk exploration, is failure. So you have to anticipate failure, and you have to be very aggressive with the trigger finger if you begin to see exploration failure. It may be, as an example, that a uranium company has a 15-hole program. But unless the geologists are drilling their worst hole first, you're going to get indications of success or failure long before hole 15. You have to apply yourself technically to the task at hand, which is to say, look at the surface anomaly, look at the projections to depth, understand something about the value proposition offered up in exploration. And I would say if the first 3 or 4 or 5 holes don't vector in on something that would cause you to continue to drill it, or if they don't generate real positive information about where to go next, that you have to sell the stock. You have to anticipate failure, and you have to keep a 40% loss from turning into a 100% loss. The second thing that you need to do is you need to pay attention to management's promises, and you need to extract promises from them. When you're talking to one of these companies, say, okay, you just raised $5 million. How much of that $5 million is going to go into the ground, and how much is going to go into G&A, and how long will the money last? If the company tells you that the money will last 2 years and it went away in 9 months, you have to sell. They are either unwitting or they're unscrupulous. In other words, they're either stupid or they're liars, neither of which are good. If they say that G&A will be 25% of total expenditures, that means they get $1.25 million to spend on G&A for 2 years, and $3,750,000 will go in the ground. You can even go so far as to look at the last 2 years of annual reports and see how much money they spent in G&A. In other words, if they tell you that G&A is going to be 25% of total expenditures, but G&A for the last 2 years has been 60% of total expenditures, you need to find out a reason why from them, or you need not to buy the stock. But matching what the management team says they're going to do with the money with what they do with the money is a wonderful early warning system for selling the stock.
If we were
if you are coming up on a period where a junior has to raise money, there are 2 techniques that work. If you are involved with a very, very, very high quality group of people, say the Lundins, the fact that they need to raise money perversely usually makes the stock go up, because they begin to promote very hard, even buying the stock themselves, so that they can raise the money at a higher price. What normally happens in financing is that pro-financiers like me sell their position off coming into a financing so they can come back into the financing and pick up a half warrant or a full warrant. What you learn with the really good guys is that they get these financings done on terms that are much more favorable to them than they are you as an investor. So perversely, if the financing is being offered up by a very high quality group, in anticipation of a financing, sometimes traders buy the stock as opposed to sell the stock, understanding that the private placement stock that's sold will be restricted, while their stock bought pre-market will be free trading. There were 5 public companies that had survived a 20-year bear market in uranium? 5. There were probably between 12 and 15 teams that could have been assembled to run a public uranium company. So if you have the availability between 12 and 15 teams and you have 5 aspirants, the probability that the team that's running your uranium company is competent is pretty high. Mm. At the top of the bull market, there was the same number of teams. Enough time didn't elapse to train a bunch of new teams. So you still had between 12 and 15 teams, but you had 500 public companies that purported to be in the uranium business. So the probability that your company had a competent team was a function of dividing the number of teams, 15, by the number of aspirants, 500, which is to say the probability that your company was well run was very, very, very close. From a cursory point of view, what you would find in the last bull market is that I sold too early. Not something I'm ashamed of, by the way. I ended up with a lot of money by my standards. And I took the lower risk part of the trade, which is to say, once the uranium price went through $40, which I figured was the incentive price for new production, I began to sell. There were a whole bunch of hot Canadian juniors that came out at a quarter and went to $1.25, and I didn't play. The pre-money valuations were often $20 or $30 million, while the net present value of the assets assembled was close to nil, which is to say I was paying $25 million for nothing. And the industry said I was getting in cheap. And the management teams were people who had failed in gold exploration, failed in oil and gas, probably failed in copper, and perhaps failed in the internet too, and were recycling their vehicles in uranium. So there was no reason from an expertise point of view to get involved in the game. There was no reason from a valuation point of view to get in the game. The only reason to get into the game was fear of missing out, which is something that even at that age, which is to say in my late 40s, early 50s, I was already not guilty of. So I would say that if the street looked at my performance in the last bull market in uranium, what they would say is he didn't sell too soon, he sold way too soon. But as you point out, most of the companies effectively went to zero. So what is way too soon? I made some money. I made what I would argue to be the rational and safe money. And I left the blow-off money on the table for the rest of my time on Earth.